In today's video, I'm going to walk you through the very first apartment complex that I bought as a general partner. So this was a few years ago. There's a deal that we still operate, and I'm going to go through how we sourced the deal, the underwriting, the business plan, the market, how we financed the deal, and just give you some lessons learned about just what we did wrong, what we could have done better, and then my own personal takeaways of somebody who's getting their first deal done and what can be implemented if somebody else is going to be doing their first deal. So stay tuned and I'm going to walk you through everything. All right, first and foremost, just a disclaimer, the market has changed pretty drastically in the last few years. So that's going to impact a lot of the stuff that I'm talking about, just how exactly, it could be applied. But still, from the overall perspective and the general perspective, you're going to get a lot of information and insight as to how a deal can get done and how you can get a deal done. You also get a look at how I look at deals, especially from then to now, how my whole philosophy and thought process has changed when looking at deals. There's going to be a lot of value. Also, we're going to keep it very high level. So this is actually, a deal that we still own. So for the sake of confidentiality of me and my partners, don't want to get into a lot of specifics. So I'm just going to keep it, relatively high level, but still going to be very valuable and impactful. All right, so let's go through what the deal actually was. So it's about 100 units. We bought it for about 17 million. It's a 1970s built property. So C-class asset, but it was in a B-class market. So it was a strong market with some strong demand drivers. Had good unemployment, low unemployment. Had some military bases nearby. Had a college campus nearby. It was relatively close to the beach. So overall, strong market. And our strategy was to implement a value-add strategy where we would reposition this property from C class to B class to be able to match the market. So the story on this property is that it was owned by the original developers when we bought it. So they built it in the 70s. They owned it since forever. Of course, they paid off the debt by that point. So they had it free and clear, and they weren't necessarily incentivized to operate it as efficiently as it could be operated. So they had more staff than was needed. They had a lot of kind of friends, family working at the property, so they kept them on payroll when it wasn't necessary to have them. So there were a lot of operational efficiencies that could be implemented. At the same time, the rents were a lot lower than the market rents were at the time. So with some renovations and updates, we were able to start renovating the property and getting the units up to market to be able to rent at a much higher market rate to be in line with what the rest of the market and other properties are getting. So what we did was we kept the third-party property management in place. So instead of trying to get a new property manager, this property manager was already doing a good job and they already knew the property very well. So we kept them in place and just implemented some asset management level efficiencies. So of course, reducing headcount, improving operations from a higher level to be able to just focus more on making the property cash flow better, as the previous owners weren't really doing that. We also had the opportunity to renovate units. So we put about $13,000 per unit, with the bulk of that going into the interior of the unit. So we changed everything: flooring, new wall colors, new countertops, cabinets, stainless steel appliances. So we really just did a complete overhaul and renovated each unit to the tune of about $1.2 million or so. So a heavy value add increase, but what that did is it made us competitive with the market. So we were able to increase rents pretty drastically, which overall increased our bottom line and increased the value of the property. All right, so how do we source this deal? So this was a team effort. So we had about 4 GPs in this project, one being myself. And one of the GPs was actually located in this market. So this market is not local to me. I'm in a different state, but the partner we had was local to the area, and he did a good job building relationships with the brokers in that market. So by doing that, he was able to get this deal off market. So we were able to get this opportunity to where the broker only shared it with a few different operators as a pocket listing. So a pocket listing is when a broker has a deal. They say, like, he has a deal in his pocket where he's not necessarily trying to blast it out or put it on the market as a lot of most brokers represented deals are. They put on their website, they put in an email blast, but with a pocket listing, it's only shown to one or a few different buyer groups that the broker has a strong relationship with. So by doing that and getting that deal that way, we're not competing with a whole bunch of other groups who will be bidding the price up, which means we can buy this property at a relatively lower asset, lower purchase price. So why would a seller ever want their property to be a pocket listing as opposed to marketed widely? Because it may seem like, you're not going to get the best price as a seller when you do that. And the rationale is sometimes the seller, the owner of the property, is more concerned about the execution of the close. Maybe it's the timeline. Maybe they have a tight timeline. They want to make sure that the deal gets closed in a certain amount of time. So they're more wanting a buyer group that can execute, and they feel confident in that execution. When you market a deal widely, you get a lot of interest from a lot of different buyer groups, some of them which may be a little green and maybe not as experienced. A lot of these groups will bid up price or not be able to close on a deal. So they may jack the price up, just by bidding higher, being aggressive, because of lacking experience, and then they'll jack the price up, and then they may not even be able to raise the capital or secure the financing to close the deal. Or, which may be even worse, they can close the deal at a higher price, but it ends up being a bad deal and a bad situation for them because they're not able to operate and they end up foreclosing. You see a lot of that, a lot of inexperienced buyers that bought deals, a lot of groups that just paid too much for their properties back in the before interest rates went up, and now they're struggling to operate now among just the many shifts in the market that occurred and made it harder to operate. So a lot of times sellers may be interested in just getting a deal closed and making sure that they can do that with little headache, even if that means that they don't have as many eyes on the deal. Another reason is that the seller may be trying to keep things confidential. For whatever reason, they may not want to advertise that they're selling their property, even amongst the commercial real estate community. So just for sake of confidentiality, they may do it, have a broker kind of do a pocket listing and pass it out to a few different groups as opposed to letting the entire industry know that they're selling their property. The key takeaway with how we source this deal is just leverage network, having good relationships with brokers, even sometimes property managers, lenders, other people in the industry is a great way to be able to source off-market opportunities and just get better deals coming through your inbox. And you want to make sure that your criteria is fleshed out and that you share that criteria with certainty with the different brokers, property managers, lenders, just people who may be sending you deals. So if you build those relationships and you have your criteria shared with them, it's going to lead to more opportunities. All right, so now let's talk about this particular market and how we selected it. So what made this market attractive? One, as I mentioned earlier, we had a partner in this market. So having a local presence gives you an advantage. You want to invest where you have an advantage. So this particular partner lives in this market, knows it very well. Typically, a local partner is going to know the market very well compared to outside investors. So you want to have that. They're going to know just where the path of progress is, the people developing. They're going to know all the nuances of like this street versus that street. And they're just going to know the overall health of the market and just what the upside could look like. So definitely that was a big value add. Two is just a strong market. It had low unemployment. It had a lot of employment opportunities. There was military bases, which is going to be stable jobs. There was a college campus, which is going to be stable jobs, and then student demand. It was also proximate to a beach, a few beaches, so it's going to have just tourist demand and people want to be there and be in the market and be in the area at all times. So definitely a strong market that made this attractive. Now, this actually plays a role in our acquisition because we underwrote some rent premiums, and just being able to meet those largely was because of the market itself. So that was able to get us very high rent premiums from the jump, just because of how strong the market is and the amount of pent-up demand that's in that market. So key lesson here is that choose a market with one where you have an advantage, whether it's a local presence or a partner or just certain knowledge you have on the market. Two, that has strong demand drivers. You want to actually study the market, review the metrics, what are the economic drivers and economic characteristics of that market, and you make sure that they complement your thesis and your strategy very well. Alright, now if you're getting value from this video, please go ahead and like and subscribe and leave a comment and share it with somebody else who may get some value from it. Alright, next let's get into the underwriting. So the underwriting, of course, is how we analyze the property, and this is where I spent a lot of my time for this particular project. Not just because of the underwriting and the standard day-to-day analysis, but I also created a custom waterfall model for this project. So you can see it has some similarities to Justin Kibble's model. So I learned a lot from his videos when I started, and I took some of his models and adapted them to create my own. So this is the case with this particular model. So I structured this financial model to match how we structured our capital raise, to be able to accurately model how investors would get paid out, how the GPs would get paid out, and just the overall waterfall distributions. So the way we structured this one is we had an 8% preferred return for the LPs. The GPs invested 10% of the equity needed, and that equity that was contributed by the GPs was treated as LP equity. So 100% of the cash flow went to the LPs until the pref was met, and then the promote was GP 35%, and then the LPs had 65%. So we actually initially had a GP catch up in there, and then essentially took it out. So we ended up skipping that step in the waterfall and just went straight to the promote. I'm not going to get into what a GP catch up is, but essentially by removing it, it favors the LPs and give them more priority in distribution, because we're going from their pref to then going straight to the promote instead of getting the GP caught up on the returns that they would typically get if you keep a catch up in there. All right, so the key takeaways from this particular area for underwriting is financial modeling is actually a pretty good and valuable skill set. Being able to underwrite is often overlooked, but it's something that's essential, especially if you're going to be an operator yourself. You want to know how to analyze deals efficiently. And then if you can do financial modeling, that's actually very valuable, especially if you're getting into the development space, you're doing anything ground up or custom. It just allows you to have a lot of flexibility. All right, now let's get into the financing. So we finance this deal with bridge debt and equity. So like a lot of groups prior to the interest rate hikes, we use bridge debt. We got about $14 million in debt with a 3.75% interest rate. And we had a 3-year term, full term IO, and we had a rate cap of 5.5%. So with this being bridge debt, it was floating rate interest, meaning our interest rate fluctuates with just overall interest rates. The reference rate they use is the SOFR, Secured Overnight Finance Rate. So if SOFR increase, our mortgage increase. So the rate cap, what that does is locks us in essentially. So, say the rate cap kicks in at 5.5%. If our mortgage increases to where it's like 6%, our mortgage, what we actually pay, is going to be about just going to be 5.5%. And then wherever we got the rate cap from, typically from like another financial institution, they're going to pay that difference. So essentially it can kind of lock you in a sense where if you have floating rate debt, it's going to keep going up depending on the interest rates, but by that rate cap, you kind of capped at a particular area. That's why they call it a rate cap. And it's highly recommended if you're doing any type of deal with bridge debt and floating rate debt, you want to have a rate cap, especially if you're in an inflationary period or if you think that interest rates can't go up, which as you can see in the past few years, they went up. So that's been very helpful for us, just being able to keep our mortgage manageable by having that rate cap in place. Now, as far as the equity, so we actually brought in another partner that raised essentially all of the equity. I think for months we had maybe about $800,000 raised of the $5 million that was needed. So we brought in another investor to close out the raise, and we were able to finish out the raise like within a month of bringing them on. So having the right people in place that really know how to raise capital and have that experience, have that network is essential. That is probably the biggest lesson learned. Just make sure you're working with the right people when it comes to raising money. A lot of people say they can raise money until it's time to raise money, and then the money doesn't come through. Another lesson learned here is just having that rate cap in place was essential and still is. Like, make sure that you mitigate your risk and you're not just being frivolous or thinking that nothing's going to happen. Prepare for the worst when it comes to closing the deal and mitigate your risk for you and your investors. All right, so overall lessons learned. So there were a lot of mistakes that were made for this deal. There were a lot of things that were done right, fortunately, but there's a lot of mistakes that was made. And this was my first deal. So this is pretty early in my career. And a lot of it I leaned on my partners. They're more experienced, they've done deals before. But there were definitely some things that I've learned over the years that had I known then what I know now, I would have advised us to do things differently. So here's some of those lessons that I learned from this deal and just going through, and things that I would have done differently on this particular deal. First area of improvement: be wary of high leverage. That's one thing I've learned, is like, you want to be mindful of the debt you're taking on. I mean, at this time, very low interest rate, and we did a good job by getting the rate cap so that we're not being punished brutally by the interest rate increase, but we still had a little bit too much leverage, which made it more risky. Even though it was cheaper debt, it still was a lot of debt. So definitely something that I would try to avoid in the future, is just having leverage that high. Another thing is, I think our exit cap rate was very aggressive. We assumed something that was a little too low. And that's one thing where it's like, a simple tweak of that number drastically changes your return profile and what your returns look like. So something that people often kind of play with as a lever, but I think we should have been more conservative on that. So now I have a completely different process for how I look at exit cap rate. Like, I want to talk to the broker, I want to get comps, etc., etc. I would look at what a deal is trading at now. So just being a lot more conservative than I was back then would be something that I would change. Now, it wasn't all bad. There were definitely some things that went well. One, as I mentioned, that rate cap was clutch. I mean, nobody knew exactly what was going to happen, but you could imagine that rates could go up at the time just because of how low they were. But nobody knew when it was coming, so we did good by just getting that rate cap in, and it's really helped mitigate our expense increases since they started raising rates. Two, the relationships that we utilized to be able to get this deal off market really helped create that opportunity. This is again mom and pop type deal where there were a lot of operational efficiencies and improvements that could be made. At the same time, you had renovation and rent increases that could be implemented. So it was a great deal, and we really got the opportunity really through relationships. So definitely one thing that we were able to do well here. All right, so those are the takeaways and the lessons learned for the asset itself. But here are my personal takeaways, as in like career growth for somebody who may be trying to get into their first deal, or somebody who might want to get into their first larger deal or want to scale up, or if somebody just wants to learn how to do deals better. Here are my personal takeaways. One, network is everything. I got this opportunity to be a partner in this deal through network. And that's one thing I've always been good at. Having the skill set, having the knowledge is important, incredibly important, but network is always going to create opportunities for you to apply that skill set and knowledge. I didn't have the experience or the expertise or the capital or a lot of the intangibles needed to be able to do this type of deal, but I was able to get in with people that were already doing deals, and that's really what opened the door for me to be able to get into my first acquisition. Second, choose partners and mentors wisely. I cannot stress that enough. You want to choose the people you work with very wisely. In this particular project, we had initial partnership, and my role was more so on the underwriting, analysis, acquisitions. Other partners were supposed to take care of the capital raising, and they fell short. Ultimately, we had to bring in another partner that raised the bulk of the capital, and it was very last minute, and he took us for a ride in terms of the equity split. He took a huge share because he had the leverage. At that point, we were kind of stuck. But having the right partners in place, or having the right partners, the right mentors, the right people to learn from, the right people to work with, is incredibly important. And remember that just because somebody knows more than you doesn't necessarily mean that you need to be learning from them. Yes, they may know more than you. Yes, you can get a leg up. You can learn more than what you know now. But if you're learning the wrong strategies and the wrong techniques from the beginning, it seems like you're moving forward, but you're taking steps back at the same time, because now you've learned the incorrect and inefficient way to do something, which then you now have to unlearn. And you may get into a situation where it works out. You're able to get a deal done, it works out. but you also can get into a situation where working with them and learning the wrong thing ends up putting you in a position where now your reputation has been hit, maybe your finances has been hit, maybe the emotional toll. Like, you don't want to take these partnerships lightly. It's very important that you vet people that you're learning from, vet your partners very well on the front end, because that'll save you a lot of headache down the road. 3, skills are a currency. So I was able to become a general partner in this property and have equity without actually having to put any of my own capital up. And that's because I was able to put in sweat equity, put in the skill set. I had expertise in a particular area, and I contributed that expertise to the group, and was compensated with ownership. So, that's not always going to be the best structure, but that can allow you to get into opportunities by using your knowledge and skill set, as opposed to just putting money and investing in. So make sure that you're always sharpening the tools in your toolbox, learning more skills, and building a network so that you can contribute those skill sets to that network and that group, and be able to open up opportunities for yourself. Lastly, every loss is a lesson. I was able to get the opportunity to be a partner in this deal because another deal fell through. There was another deal that we had under contract that essentially we never closed, but the lead sponsor from that deal liked working with me, liked what I brought to the table, so she invited me into another project that we ultimately closed. So definitely a major takeaway from there is, just because something doesn't work out doesn't mean that it's not still a positive opportunity. You can learn from it, build skills from it, build relationships from it that can ultimately lead you down the road to success. So always look at it as that. All right, so appreciate you for checking out this video and staying through to the end. Hope you got some value out of it. Hope you able to learn from it, learn from the mistakes that I made, learn from the mistakes me and my partners have made, and hopefully this allows you to level up and get more progress in your real estate journey, your business. If you're trying to get your first deal done, or just trying to close your next deal, or just need help in expanding your portfolio, please go ahead and subscribe to this channel. I'll be putting out more videos, and if there's anything that I can do to help you in your process as you're looking for deals, don't hesitate to reach out. You can find my information, my LinkedIn, I'm in the bio for this channel. Also leave a comment, I do read those. And until next time,